Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about one of the most misunderstood continuous pattern in Forex trading, the bearish hidden divergence. You will discover how this pattern consistently signals prime opportunities in a downtrending market. More importantly, you will identify it with precision. By the end of this video, you will be able to understand exactly how to spot these setups, execute them with confidence, and avoid the common traps that can cause most traders to fail. Whether you are an experienced trader or you are just starting your journey, mastering the bearish hidden divergence will give you a significant edge in your trading arsenal. Let's begin with the fundamental structure of this powerful trade-up pattern. Now, what is a bearish hidden divergence pattern? This pattern is established during a downtrend where price consistently make or form lower highs and lower lows. This pattern emerges when the market pulls back temporarily against the primary downtrend movement. What makes this pattern particularly valuable is its ability to signal the precise moment when the downtrend is likely to resume. Now, this pattern explained happens always in a downtrending market when the market is making series of higher highs and higher lows. When you analyze price action, you will need to focus on two critical components. First, you need to observe how price creates lower highs in each overall downtrend. This means each peak reaches a level below the previous one, confirming that sellers remain in control. Secondly, you can also pay attention to your oscillator, whether it is the RSI. If you want to make use of your RSI, you can make use of your RSI, or you can still make use of your MACD, whichever one you want to make use of. During a bearish hidden divergence, this indicator will show you a higher high, creating that at crucial divergence between price and momentum. Now let's see an example of what a divergence is. When price is making a series of higher high and our indicator is making a series of lower highs. This is a pure example of a divergence in price. Now let's look for a good example. Okay, can spot an example at this area. As we can see, price is making a series of higher high while our RSI indicator is making a series of lower high. If we can still look at our MACD is making a series of lower high. That's typically what this divergence mean. The magic of this pattern lies in its reliability. When price show weakness by falling to each previous high, the indicator suggests temporary strength. This contradiction always is confirmed that bears are quietly regaining control, preparing for the next leg down. Think of it as the market taking a breath before continuing its journey to the south side. The key the key to trading this pattern effectively is patience. You must wait for both components, the lower high in price and the higher high in your oscillator, to align perfectly. This synchronization provides the highest probability setup and help you avoid phase signals that could compromise your trading account. Now let's understand how we can trade this strategy. We need to focus on how to execute this trade effectively. The entry process requires three specific conditions to align. First, you have to confirm that price has established a clear downtrend. The first rule is to confirm that price has established a clear downtrend. After that, we have to wait for price to form a lower high. We have to, as we can confirm from our chart, that price is making a series of lower lows and lower highs, so we are in a downtrend. Then we need to confirm that price should form a lower high. When price form a lower high, the third thing we need to confirm is to verify our oscillator display is showing a higher high during the same period. So as we can see at this area, price is making a lower high. This is a lower high, a lower low, a lower high. And as we can see, our oscillator, our RSI, we are making a higher high at this area. And if we can look at our MACD at this particular area, we are also making a higher high. So that is our third confirmation. Your stop loss placement is crucial for protecting your capital. Place your stop loss above the recent swing high. So if I'm to enter this trade after our confirmation, we put our stop loss above the previous swing high. We put it in a place where even if price reverse against us, we have enough buffer to safeguard our trade and give our trade a breathing room. The level is logical because if price breaks above this point, it invalidates the bearish hidden divergence pattern entirely. Remember, proper risk management determine your long-term survival in the market. Now let's look at how we take profit. We take profits by looking for previous support levels where price have reacted before. We can look at areas like this. These are previous support level below this area where price have reacted from before. We can take our profits at this particular level. We can also take our profits, our general rule profits, by considering a risk to reward of 1:2, meaning your potential profit should be at least twice your risk. Now let's not forget position sizing matters a lot. Your next critical decision: never risk more than 1 or 2% of your trading account on a single trade, regardless of how confident you may feel about that setup. Always calculate your position size based on the distance between your entry and your stop loss, ensuring your risks remain within those parameters. We have to always never risk 1 to 2% of our account so that we can stay in this trading game for a longer period of time. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on the notification bell for more trading tips and strategy. Thank you for watching and I will see you in the next video.